If these past 3 years have taught the owner of House of Coffee anything, it's to be ready for the worst. Your customers can suddenly disappear. You can be forced to shut down for extended periods of time and wonder when things will get back to normal. This is why you'd like to inform the owner of how much room House of Coffee has before it's getting in the red. That's called the margin of safety. The margin of safety is the difference between current sales and break-even sales. It tells businesses how far past the break-even point current sales levels are. This is important because a business can see how much sales can drop before incurring a loss or failing below the break-even point. And what do we learn about margins? The higher the margin, the better. Margin of safety is no exception. The higher the margin of safety, the lower the risk is to incur a loss. Simply put, there is more cushion. If House of Coffee is expecting a recession in the forthcoming year, they need to know how much cushion they have. What is their safety margin? Similar to other calculations we've learned so far, margin of safety can be measured in dollars and in units, and also as a ratio. The margin of safety in dollars formula is total budgeted or actual sales less break-even sales. If you recall, House of Coffee's what-if recession scenario and their large cappuccino contribution margin income statement examples, we found the break-even point in dollars, which was $8,750,000 in sales revenue. Separately, House of Coffee found that with $14 million in sales revenue, they reached their target profit. So let's relate this to our margin of safety calculation. If $14 million is our budgeted sales revenue and $8,750,000 is our break-even sales revenue, we can plug this into the formula and see our margin of safety in dollars. $14 million total budgeted sales minus $8,750,000 break-even sales equals to $5,250,000 of margin of safety. This means that at House of Coffee's budgeted sales level of $14 million, they can lose $5,250,000 in sales revenue and still not suffer a loss. They will break even. If sales revenue declines more than their margin of safety, they will have a negative operating income, or in other words, operating loss. Just like target profit, we can add our margin of safety to our break-even point. In the face of a possible recession, House of Coffee may want to shift to thinking in terms of margin of safety rather than target profit because they expect sales revenues to decline and want to be prepared. Hello, certified professional. If you are enjoying this course, get accredited with CPE credits for watching it. Click the link in the show notes or visit cpeflow.com to access the full course ad-free and pass the final assessment quiz to officially earn your NASBA approved CPE credits and certificate of completion. Now that we know our sales revenue in dollars, we can use the same concepts we learned in target profit and contribution margin and convert from dollars to units. We simply use this margin of safety in units formula. Margin of safety in dollars divided by the unit sales price. So the question we'd like to answer here is, what does this look like for House of Coffee's large cappuccino? $5,250,000 margin of safety divided by $7 unit sale price of the large cappuccino equals 750,000 margin of safety in units. This means that with House of Coffee's margin of safety of $5,250,000, they can sell 750,000 fewer large cappuccinos than budgeted and still break even. If their sales decline more than 750,000 units than expected, they will have an operating loss, which unfortunately happened during the height of the pandemic when barely anyone would leave their home and House of Coffee had to shut down temporarily. Our margin of safety can also be expressed as a percentage or a ratio using the same information and calculating it differently. The margin of safety ratio formula is margin of safety in dollars divided by total budgeted or actual sales in dollars. House of Coffee's large cappuccino would look like this. $5,250,000 margin of safety, or MOS, divided by $14 million in total budgeted sales. That equals to 37.5% margin of safety ratio. This means that with House of Coffee's margin of safety, their sales can decrease by 37.5% and they will still break even. The neat thing about the margin of safety ratio is that it can be applied to sales dollars and sales units. If we know that sales can decline 37.5% and we are still safe from suffering a loss, we can use these alternative formulas for margin of safety in dollars and in units by simply multiplying the margin of safety ratio to either dollars or units. $14 million total budgeted sales in dollars multiplied by 37.5% margin of safety ratio, that equals to $5,250,000 margin of safety in dollars. Or we can look at 2 million total budgeted sales in units multiplied by 37.5% margin of safety ratio, and that will equal to 750,000 margin of safety in units. As illustrated here, the margin of safety is an important measure for businesses to know, and its calculations are versatile as they can be expressed in dollars, also in units, or a ratio. Margin of safety helps in planning and budgeting, especially when we expect a recession. As you can see, it is crucial for a business to determine how low it can fall. Unfortunately, this pandemic has taught all businesses that anything can happen at any time. Therefore, while it's great to focus on profit, a business must know how low it can fall before it's getting dangerously close to losing money and potentially needing to close permanently, something that has happened to many businesses during the height of the pandemic. In our next lesson, we will be changing these numbers to prepare for different possible outcomes. What if House of Coffee had its best sales ever? How will that affect their profit? Or what if House of Coffee had their worst time with the lowest sales? How will that affect their losses? Let's get to it in the next lesson.